So this guy that I called, his name was Barry Cummings. I called him yesterday live. Never talked to the guy before, never been in this market. Told him who I was. He was in a hurry, but he said, I'll send you a 72 unit. These emails came through just right after we got off yesterday. There's the rent roll, okay? And then he sent me these profit and loss statements. He did break them down by month, and then he has an annual profit and loss statement over here. So I have them all pulled up in this PDF here, but I'll just share with you guys. I just wanted to show you guys the emails that came through, and then here is the profit and loss statement. I don't know why my screen's going black here. There's a lot of stuff going on. Hang on, guys. Screen's going black for some reason. Okay, so what we did is we got a profit and loss statement, and this is for 2020. So this is January through December of 2020. I also have every single month. So what I can do is I can go through and look for discrepancies. Like if there was a really high month, like they spent 11,000 on building repairs, in May, they actually lost money in May. And, I could go through every month. They made money in June. So I would do that if we got a little further, but annually is fine. You can look at an annual profit and loss statement and dig in later on. So income is always at the top. This is just a standard P&L. Income's always at the top, gross profit, and then you have your expenses. Okay, so this is my gross collected rent. This is based on this rent roll that he sent me. Okay, this rent roll, these all look the same. You have rent, deposit. I really like to have move in, move out date. They don't really have them on, they don't have them on this sheet, but this isn't, the move in, move out date is important because you can start to prepare when leases are going to be coming due. So if they signed all these people up, January 1, 2019 or January 1, 2020, and they all expired, January 2021, then you have everybody on month to month. That's important to know. But again, not a showstopper. You don't need that data in order to make an offer. So I have all these, this is that rent roll. This is where the income comes from. So they are collecting $744,000 of gross income on this property. Now, the expenses are where you got to dig in, because a lot of times expenses there can be standard expenses that are left out, and there can be expenses in there that you might not incur. Okay, so you have to be able to dig into the expenses. I'm just going to go through. I'm doing this live, by the way, so I'm going through with you guys live. This is the deal that I got yesterday. So the one thing that I really noticed about this one is he has his total interest expense in there for his mortgage. And he has his mortgage expense in there, which is fine, but that's not a standard expense on the property. He has internet. His management fee is really low. Typically a management fee is anywhere from, a management fee can be anywhere from 8 or 6 to 10%, depending on the size of the building and what they're doing. So your management fee on a bigger building might be less, like 5 or 6%, but then you have payroll for a leasing and a maintenance person. Okay. If you have a smaller building, that management fee might be 8 or 10%, but it's all encompassing and they handle the leasing and everything and the work orders and all that stuff in-house, and you don't have a payroll expense. Okay. Typically what you see is above, in my experience, above 32 units, you're going to start to have a little bit of a payroll expense on your expense sheet. And at 100 units, you can afford to have a full-time maintenance and a full-time leasing person. And those salaries are typically around 40,000. Okay. I'm giving you a lot of data and information here. But those salaries are typically around 40,000 each. So you'll have about 80,000 in payroll plus your management fee if your building is closer to 100 units. Cool. So we're going down. They do have a little payroll, so they're paying somebody on the payroll here. They have some accounting, some professional fees. I don't know what this rent charge is. They did do $128,000 in building repairs. So if I got back to this broker, we got past LOI phase and they're really interested, I would want to know what those repairs were. Like, what did they do? They replaced roofs. Is it HVACs? Is it unit turns? What is this $128,000 repair line item? I'm going to look at the monthly real quick. It's not line itemed out. So they just spent $5,000 that month. They spent $10,000 that month. They spent $6,000 that month. So you can see them spending money on the building. but it's not line itemed out for you, which is, it's okay. You'll get that information when you later on. Okay, so there's 128,000 right there. They have their taxes in there, their gas and electric, total utilities. So total expense is $600,951, but they're including their mortgage in that. So this is why I wanted to do this live with you guys. A mortgage is not a standard expense in a property. So the fact that he has that in there, if you looked at this net ordinary income, this number is really off. And if you divided 143,900 by a 7% cap rate, that value would be $2 million. And you would be at a $28,000 per door. You'd be way off. So you have to add back that mortgage expense because that is not a standard expense. Now, the other thing that they're missing in this P&L, and I just put this together this morning. I just did this morning. I just typed up an Excel sheet. You can take a screenshot of it. This is not, again, I didn't want to do this with some like intricate underwriting spreadsheet that none of you guys have. I wanted to do this pretty standard. So here are your standard expenses that you'll have on a building. Real estate taxes and insurance. Typically insurance is anywhere from $250 to $300 a door. And then your taxes are obviously based on your mill rate in your property. Now, don't overthink the taxes. You can find out what the taxes are going to be. You can make assumptions. And when you get into due diligence, what you'll do is you'll call the county and see when the taxes are going to be reassessed and at what mill rate is it going to be in that market. And you can figure out what your new tax rate is going to be. This number is important when projecting out bigger deals because taxes can increase anywhere from, they can increase and really hurt your net if you're not prepared for them. So for the most part, your taxes, whenever they get reassessed is when you're going to need to, make sure you understand what they're going to be reassessed at. But that's okay. Just go with the tax rate that's currently coming in. Trash removal. I didn't see trash removal on here. I'm actually going to pull them up. I'm going to do a little side by side. So I did not see, I saw sanitation. That's probably trash removal. Hang on one second. I got a lot going on. It looks like my computer's, let me make sure you guys can see this here. Sorry for this delay, guys. Let me pull up this Facebook group. You guys could drop some, I'm looking at the comments here. If you guys have any comments on the P&L, I like to sort of read them as I'm going through. If you guys have any comments, it's, all right. So the other standard expenses, trash removal, it looks like they have some sanitation expense. I guess we'll assume that's trash removal, but we would dig into that later on. They have electric, gas, water, and sewer. Now, electric, gas, water, and sewer, you need to understand if the tenants are paying their own electric, if the tenants are being billed back for water, and if there's gas on the property and who's responsible for it. In my experience, gas and water are usually a landlord-held expense, and electricity is definitely a tenant-held expense, and about a majority of the time, you're billing back for water, but you have to pay that expense and then bill the tenants back. Typically what we're doing is an $850 rental rate. And then, you bill 20 or 30 bucks for water, depending on the size of the unit. 3 bedrooms are about 30, 2 bedrooms are 20, right? Makes sense. So if they don't have a water and sewer bill in there, you're going to dig into that later on. Cause I don't see a water bill here. So who's paying the water? That's what I would ask, right? Where's the water coming? There's gas and electric for $8,800, but no water bill. And again, that's okay. Like if you guys see these gaps, these are not showstoppers. These are not like, oh, I can't do anything until I figure this out. It's just mental notes that you need to make in the deal that you need to iron out later on. And when you make your projections, you're going to base it on expenses that include the water anyway. So it's okay. Like don't let it be a showstopper for you. There's legal, the management fee we did talk about, repairs and maintenance, big expense that you guys need to be prepared for. There's a difference between standard repair and maintenance expenses that are going to be on your building and then capital expenses that are major CapEx items. Okay. So you need to be able to delineate what is a standard repair and maintenance expense and then what is a capital expense. If you're replacing a roof or you're doing like a parking lot or you're painting the building, those are capital expenses that are going to come out in a major CapEx account. Okay. Standard stuff like, fixing toilets and work orders and even a small unit turn to like clean a unit or trash out a unit. Those are standard repair and maintenance items that are going to go on the profit and loss statement that are just standard repair and maintenance items. Okay. This P&L is not very detailed. I have other P&Ls that are very detailed. And I think it would behoove everyone if I showed a P&L that was really detailed, just so you guys can see the difference between one that is, because you guys are going to see some different types of P&Ls, and I want you to see one that has everything. So just give me 1 second. I'm going to pull up a more detailed profit and loss statement. Hang on 1 second, guys. Give me 1 second. Let me try and pull this up, because as I'm going through this profit and loss statement, I want you guys to see one that's a lot more line itemed out. Everyone, bear with me a second. Okay, here's one that's a little more line itemed out now. So hang on, let me drag this over here. Again, we're still going to make an offer on this property. By the way, this 72 unit, I'm still making an offer on it. You guys, this came from yesterday. This is part of the challenge, is to make an offer. So we're going to make an offer on this. I want you guys to see a profit and loss that's a little more detailed out. Okay. So this is just going to help some people put it into perspective of all the other expenses that are going to be involved in the property. You have your possible rent. Here's some other ancillary income. And then they have the administrative expenses, and they have them line itemed out. Okay, you see that? So these are some of the line items out. Now, you will most likely just get an admin expense and you'll get a number. But I want you guys to understand what all encompasses that admin expense. Okay, there are your management fees. You got your office supplies, things like that. Then you have some other advertising. Here are your taxes. Here's your utilities. There's that water bill that I was telling you about. You have electric and water. This was one of the ones that the guy was paying the electric on. You have your maintenance and your management and your payrolls. Here's your payroll expense. Then you have your operating expense. Here's the trash removal. This is a bigger building, so there's some exterminating and some uniforms, but you also have your decorating and cleaning expense, maintenance and repairs. So here's more of the repairs that are being made, on a daily basis in the building. Then there's some landscaping and some ground expense. And then you have your net operating income. And then this is what I was telling you guys about. Then you have an extraordinary expense for roof replacement, concrete work, pool renovations, maintenance equipment purchases. You have bigger expenses down here that are extraordinary expenses. And then you have your so they have two net operating incomes, one less expenses and one less extraordinary expenses. The one less expenses is the value you're going to go on to get your cap rate. Okay. So I wanted to share that with you guys. That's not to confuse anybody, but it's to let you guys know that I don't see a lot of these things line itemed out, which is okay, but you will dig into that when you get into due diligence. Okay. At this point, we're just kind of taking what the profit and loss that we have, and we're going to make an offer based on that. Cool. So here is this one is the 2020. Similar narrative. So the other thing that I like to look at is I like to compare 2019 to 2020. And as you can see, income was a little down. And let's look at expenses. I don't like that they added the mortgage in there. It's crazy. Total expenses were 600 in 2019. And in 2020, total expenses were 566, but they still had the mortgage in there. So we'll add that back. Okay. And then they did send the rent roll too. So I'm going to look at this rent roll, and we'll go in and look at the property, because we want to do all deal analysis here. So looking at the rent roll, you can see the narrative here about 875. You got a 1,035. This one, if you see a lot of this where rents are much higher than all the other ones, they may be a weekly rental. Okay. So a little tip there, if you see a couple of rents that are way higher, you may want to ask if those units are rented out weekly. Okay. And then you see some 795s, 825s, some 875s. So the narrative is about 850 on average. And then it looks like some 975s and some 925s. So I would be curious when I walk these units, because in due diligence, we walk every single unit. Okay. So when you get to that point, when the LOI gets accepted and you go under contract, you will walk every unit. And I would bet you these 975s and these 925s probably have maybe some updated LVP flooring, or they've updated the cabinets, or they've done some sort of updates to them. They've turned them a little bit. Maybe not, I may be wrong. But in just my experience, you typically get, higher rents when you turn some units. And that may be what the repairs are, that 128,000, they may be just slowly turning the units. These are also all questions that you can jot down and call. I can call Barry Cummings back and ask him some of these questions. So if you guys really want to get those answered, you can call the broker back and say, hey, can you tell me about the 128,000 they spent last year in repairs? What did that go into? Right? Where was that spent? For me, like, I'm just going to throw, I can tell that these numbers are pretty on par with decent rental rates. So I'm going to put a placeholder in there for CapEx for like major things at $100,000. And then based on due diligence, I can adjust. Okay. I haven't seen the building. So if you're fortunate enough to be investing in your backyard, you can maybe go do a drive-by and kind of look and eyeball this building. We're going to look at it on Google right now too. So I can look at it on Google and kind of get an idea, and then put a placeholder in there for CapEx. The goal is like, don't be so obsessed with getting to the like exact number. Like, you just want to get close. So you want to get in the 5%, 10%, and you're able to do that with these figures to get close to that value. And then when you get into your due diligence, you can really refine and polish up those numbers. And if you have to go back for, a retrade, as long as you find something in there you weren't expecting, it's okay. It's okay to do that. Cool. So there's the rent roll. So here's what we're going to do. We're going to start to I want to start to wrap my head around what this building looks like. So I'm going to pull it up here. Okay. So here's the address of the building. This is in Bowling Green, the market I selected. I'm going to go in here and look. What I'm also doing here on deal analysis. Okay. So deal analysis, not only numbers, but it's also looking at kind of what's around. Okay. I'm going to be going through and I'm going to be looking at what is surrounding my building. Okay. I got a park. I got a mini mart. That's a good thing. You want to see activity, right? I look for a Kroger. I'm looking for my Kroger. There's a Panda Express. I like a Kroger, a Starbucks. If you can see a Chick-fil-A, anything like it, there's my Starbucks. Okay. How far is that? It's not far from the property. I'm actually pretty close to, a lot of stuff that's going on. And when we talk about building the team tomorrow, like, we will get, the lowdown on the area a lot better too when it comes to building the team. And we can adjust our offer based on the conversations tomorrow before we submit the LOI on Friday. If, we have some conversations with some property managers tomorrow and they say, hey, Lee Street is, a really rough part of town. You want to, really factor in some more for vacancy or something like that, then we can adjust at that point. The goal is to get to a valuation today and feel good about the property. So I'm looking around, guys. This is what you need to be doing. I mean, you're basically driving the property, but you're just doing it virtually. We actually have I have some virtual reality headsets, and I actually can go in and look around and drive the property myself inside the headset. Those cost money though, so you don't need to do that. It's the same thing you're doing right here. You can actually go into Google Maps and just look at it. So I'm going to do a satellite view too, because I like to see what's around. So I'm very close to, the Bowling Green, the main Bowling Green metro. Like, if my building was like out here, or if it was like up here, I'd be a little more concerned about, my tenant pool. But if I don't have, necessarily like a military base or something, that's okay. If my building is close to all of the commercial stuff that's going on, I know that my tenants, will probably be working in the city. They'll probably have, these jobs here, and that's a good thing. Okay. So again, I'm just kind of looking around, and I see some solid businesses. Let these bigger businesses do the hard work for you. Like if you see that, you know, there's a Kroger on the corner or a Publix or a Chick-fil-A, like those companies do massive market demographic due diligence before they put a building somewhere. So if you see that, right, look at that as a green light. That's a good sign. Okay, it's a good sign. All right, so I feel good about where it is. I feel good about proximity to the city. We got the total income on the property. So here's what we're going to do. Let's get to a number here. Again, not using a crazy spreadsheet. I'm just going to go with some standard figures based on what the current property is producing. And then I'm going to do it based on what I think, yeah, there's a university there, university, all that stuff. I'm looking at some of the comments now. So I had the same question. How do I get funding? All right, we'll talk about that with building your team. What's the asking price? He didn't give an asking price. He actually just said, he said the market's a 7 cap. I'm going to take his word for the 7 cap on the market, but know that you can have a variance and I can know what the offer is. If it's a 7, if it's an 8, if it's a 6, if it's a 10. And when we talk about building your team tomorrow, you know, one of the things we're going to lean on is a property manager and some local boots on the ground that can hopefully tell us what the market cap rates are. Okay. But it's important to like, don't get so fixated on it has to be a 7 cap. Like I'll give you some rules of thumb. The more popular MSAs like the Nashvilles and the Atlantas are between the 5 and 6 caps. And then you start to get the tertiary markets like the Huntsvilles, the Chattanoogas, the Bowling Greens, you're probably 7 to 8 caps. So you got to kind of know your market based on your population size and desirability. And that always tends to reflect in your cap rate. But you also need to do your due diligence because, you know, just 1% in a cap rate on a large building can be $100,000 swings. So you don't want to be missing the mark on your offers because you weren't aware of what the potential cap rates are, right? And don't get overwhelmed with like, I don't know my cap rate in my market. Like you can find that out. You can make estimates and don't let that stop you from making an offer. So here's what I'm going to do, guys. I got for 2019, I got $143,000. I'm actually going to pull up my calculator on the screen so you guys can see what math I'm doing here. I got $143,000, 900 in net operating income. Okay. That includes a $378,000 plus $40,000 interest and loan expense. I'm going to add that back because debt service does not come out of your NOI. Debt service comes after your NOI. And then your DSCR or your debt service coverage ratio is your debt service divided by your net operating income. You look for a 1.25 or higher. If I lost some of you guys there, it's okay. But your debt service comes out of your NOI. And you need to, obviously your NOI needs to cover your debt service by hopefully a lot. The more, the better, but you're looking for a minimum, in my opinion. You should not be doing a deal that does not cover the debt service by at least 1.25. What does that mean? If my NOI is 125,000, then I don't want my debt service to be any more than $100,000. Does that make sense? Because if my NOI starts to trickle down, my expenses go up, I have some vacancy. Now I'm flirting with not being able to float that property. You don't want to put you and your investors in a dangerous position to not be able to float that property. I love a 1.5 DSCR, but sometimes that's a little unrealistic if you're in a competitive market. But 1.25 is the benchmark that a lot of lenders look for as well. So lenders will look for that 1.25 to be able to loan on that deal. So that's a little tip there, so I'm going to do 143.9 and I'm going to add 378,298. And then I'm also going to add back the 40,745. Okay. So the true net operating income, according to this profit and loss statement, is 562,943. That's what they're saying. Okay. And he also said it's a 7 cap market. Okay, I'm going to take his word for it. I'm going to take the broker's word for it right now that we're going to run our numbers based on a 7 cap to get to an offer. Here we go. This is an example. I'm not going to actually, I don't believe this is the right net operating income. And I'm going to share with you guys why. And also I'm going to share with you guys some rules of thumb that I use to help me get to valuations. I'm going to just for humor me for a second, I'm going to divide that by, so that's 8 million. The building's not worth $8 million. Okay. But that net operating income divided by the 7 cap is saying it's worth 8 million. Okay. And I'm going to divide that by 72 units just to get a price per door. I'm not going to be paying $111,000 per door in Bowling Green, especially for properties that are rented out for $850 on average. Cool. So that's BS. This is where you have to be able to do your own independent math. And this is the reason today is so powerful, is because you've got to be able to do your own independent math here. So what I'm going to do is a good rule of thumb for us. This is for us. We operate typically at about $3,800 per door annually in expenses. You can write that number down. You might fluctuate from that, and it's all going to come down tomorrow to building your team. When we talk to a property manager, we're going to ask them what they typically run on what's called an OPEX, or operating expenses per annum. What is their OPEX? We run currently about $3,800 per door. Okay. So 3,800 times 72 is about $273,600 in annual operating expenses. And then I'm going to take the 744,851 and I'm going to back out the 273,000, and I got 471 is my net operating income based on that number. Now, as a percentage of income, you can also do it this way. So as a percentage of income, I'm going to write down this 471. So 471,851 is my NOI based on my 3,800 per door. Now that's very, very low as a percentage of income. So at 744,000, some people also like to do the 50% rule times 0.5. Some people also like to do the 50% rule. Okay. And that would give me 372,000 as my NOI. Okay. It's kind of a big swing here. And the reason it's a big swing is because I didn't take taxes and insurance out of that 471. So when you take taxes and insurance, which are an expense that does come out of the NOI, then that 471 is going to be lower. What I can do, honestly, guys, is I can find myself a little bit of a middle ground in order to put a placeholder in there to make an offer. Okay. So for me, I'm going to put the 50% rule is a little bit higher of an expense rate. And that makes me feel a little bit more comfortable. Okay. This is all about just making this first offer, guys. And you got to be able to feel comfortable and not have everything perfect, because nothing's ever going to be perfect. So you have to be able to make some assumptions in order to get to an offer to then see if you're even in the ballpark. I think too many people are like getting inundated with these financials and trying to iron out exactly what the expenses are and exactly what the NOI is going to be. And they get stuck in that sort of that phase, and they don't end up making any offers. Now, you may make an offer based on this number, and then they're going to tell you to kick rocks, and you just wasted all that time. So 372,425. Let's go with that number, okay, for an expense rate. I'm not taking their expenses, and I'm not going to take their NOI, because I think their expenses are kind of really beefed up. Let's go 600,000. Just humor me for a second. Let's go 600,951, and let's subtract the I'm going to subtract that 420,913 is 180,000. Yeah, divided by 72. I mean, that's 2,500 a door. You can't operate anything at 2,500 a door unless you're going around collecting the rent and mowing the grass and handling the plumbing issues, and you don't want to be doing that. So here's what we're going to do for this particular one, 744,851. We're going to multiply that times 0.5. Gives us 372,000 as a net operating income. That does include taxes and insurance. Okay, that includes taxes and insurance. 372,425 divided by a 7% cap rate in Bowling Green, Kentucky, gives us a valuation of, is that 5 million? 5,320,000. Okay, $5,320,000, $364 is my value of my building. With some assumptions, that's the value of the building that I'm placing on it. What comes out of that is my CapEx when it comes to making my offer. What comes out of that is going to be my CapEx. Okay, so if I think I got to put 100,000 into the building, then I'm going to back out 100. I'm going to back out 100,000 and make an offer based on that. Now I'm going to start much lower with my LOI. I'm not going to go up to my maximum based on what I think the value is based on those numbers. And this also does not include. So I'm gonna tell you guys a little caveat because of this deal. This deal seems to be pretty stabilized. So this is also not, this number is not based on like a projection of like if my building was if the building was vacant, let's say, and I'm going based on the income that it produced and the building is vacant. It doesn't mean that building doesn't have a value. You just have to place a value on what it could be when it's rented out and then work backwards. Does that make sense? So if you guys, I'm gonna try and talk to everybody now. If you guys did the homework yesterday and you got some deals and maybe you found a deal that's a little bit wonky and the rental rates are super low, like you need to go in and project what that building can produce. Like you want to project this number. So I put these things in here and I can do some checks for you, but let's see that this is the rental rate of all 72 units, 62,935. Okay. And I'm going to multiply that times 12, which gives me about that 755 number. Okay. So I double checked it based on the rent roll. I double checked their income and they're pretty close. And then I'm going to do the 50% rule just to give me some guidance. And then I'm going to do again, that's divided by that 7% cap rate. At 5.3 is kind of that number that I know that if I was around 5.3, I should look into this deal further and it's worth going into due diligence, potentially going under contract because I feel good about that value. Does that make sense to everybody? The other thing that I'm doing here is what I want to do when it comes to market analysis is I want to look at apartments.com, free resource. You guys go to apartments.com and I want to see if there's a value add component in the deal. Because right now my value add, like I don't see some expenses in there that I need to see. My payroll is really low. So I know I'm going to have management expenses. There's some other expenses that I'm going to have to add. I'm going to have to really dial in this financial statement. And it doesn't tell me too much about where my value add is just yet. That's okay. You can find out the value adds during due diligence. Don't let that stop you from making offers, people, because I'm going to go to, where is this property here? Stand by. Okay, I kind of covered a lot here. Yeah, kind of covered a lot here. If you guys are in the chat, you guys can drop some stuff in there for these last 10 minutes because I kind of went through how I got to a standard valuation based on that rent roll. And I want to make sure I didn't kind of blow past everybody. The whole purpose of me doing it kind of this grassroots way was to show you guys that, you don't need some fancy calculator to kind of get in the game. The calculator can come later on when you're doing like syndications and you're doing prefs and preferred returns and you're returning equity to investors and all that stuff. That's when those calculators will come into play, but don't let that hinder you from, getting in the game. So here is here's apartments.com. I like to see what my competition is renting for. And I like to see kind of where I could push the rents. So all mine are 3 bedrooms and they're apartments. So I want to see what other 3-bedroom apartments they have. So this is cheaper, but it looks like this is I don't know if that's a room rent because that's cheaper than my rent. I want to look at my value add component from a rent perspective. 4-bedroom for $525. I don't know how that's that low. 3-bedroom for $395. Something's wrong with apartments.com. There's no way that's a 3-bedroom. 3 to 4 bed for $725, $770. So I'm at the top of the market on the premiums from what I can see so far. Okay, I'm going to do some more homework when it comes to building the team tomorrow, but for the most part, I'm recognizing that my rents are probably, from what I can tell, and it looks like some of these numbers are off, but I'm at probably the height of what I could get in Bowling Green, Kentucky. at this 875, 900 mark. So I'm not going to factor in a tremendous rent bump to fluctuate my numbers that I typically would had I looked at this and saw everything's renting for 1,500 bucks and I know these things are well below market. If that was the case, then I would run my numbers based on a projection of what I could get, also known as the gross potential rent, and I would back my expenses out of that to get my net operating income, get my value from that, and then back out the CapEx and the repairs and everything that it would take to get the property to that point and get my value that way. Does that make sense? Does that make sense here? You guys may have to, good, I'm glad these are gems. You guys may have to, watch this again, because there's some things that I'm dropping here that, as you're going through your deal, this is about you guys, right? So before I get off this screen, but I'm going to crush some limiting beliefs here in a second, but before I get off this screen. So I'm going to, as of right now, tomorrow's building the team. We're going to talk to a property manager. I'm going to refine my expense number. I'm going to refine my price per door and expenses. I'm going to see typically what they're operating their other assets at in that market. Okay, they may tell me it's $4,200 a door in Bowling Green. Hey, things are just a lot more expensive up here. It's $4,200 a door. Cool. And I'm gonna maybe plug that number in. Okay, so tomorrow is building the team. We're gonna do that, and then we'll at the end of that day tomorrow, we're gonna get ready to submit the LOI by Friday. For me right now, I'm gonna be coming in less than $5 million on the LOI. Just letting you guys know, I don't like to lowball, but I like to make sure that I have a little bit of room, because this is based on what I think is sort of the market based on the income and expenses, okay? And then if I divide this number by 72, that's $74,000 a door. So price per door is important to know. $74,000 for a 3-bedroom is not bad. It obviously depends on what market you're in, but Bowling Green being a pretty strong tertiary market, if the units are in good shape, $74,000 is not bad. And for my single family people, it passes the 1% rule. If I'm preaching to these single family people, that's the 1% rule, it passes. So if you guys don't know what that is, it just means that the price per door is less than the rental rate here. So that's a good thing, right? And price per door is going to matter when you start looking into, what things have traded at and what prices per door. Okay. So I'm coming in, as of right now, I'm coming in a little less than $5 million on my offer for this property. And I'm going to submit an LOI and I'm going to see what the guy says. I know based on the income that produces and a conservative 50% expense rate right now, and I know that my price per door expenses is less than that 50% expense rate. So I'm being conservative with my numbers. I know that I could pay $4.9 million for this property and it would be a win. Cool. All right. That was, I kind of went into the weeds a little bit there, but drop a number 4 in the chat if some of the stuff that I said there was kind of resonating with you guys as far as helping with valuations in the property. Drop a number 4 in the chat. They didn't have an asking price. They just sent me the profit and loss statements. And so in some places, a lot of these properties will not have an asking price. I'm seeing some 4s come through. I appreciate it. If I delivered some value today on deal analysis, hopefully, me sharing a profit and loss, how I look at a profit and loss, and how I look at a rent roll. And I showed you guys another profit and loss statement that was a little bit more detailed. That's where you can start to read these narratives and identify the gaps. You guys, if you go back, I shared with you guys some expenses that should be in these properties. So if they're missing in your P&L, like factor that in, that they're missing some of those expenses. And you can dig into those profit and loss statements too. If you have a good relationship with that broker, like I would call Barry Cummings back and ask him what the repairs and maintenance are on the 72 unit. I'm actually going to call Barry tomorrow. If you guys drop in here live, we're going to call Barry tomorrow and dig in a little bit. As part of building the team, the broker needs to be on your team too. Having good brokers in that market is part of building your team. We're going to call property managers tomorrow. We're going to call people involved in the deal. I might call a lender. I might call a lender tomorrow and try and talk about financing. But tomorrow is going to be a huge, huge day, guys. Tomorrow is going to be really, really big about finding boots on the ground. Who do you need on your team? Who's going to run the asset? Who's going to finance the asset? How are we going to get the money? Like all those things are going to come into play tomorrow. today was hopefully really helpful about, what's up, Jimmy? How you doing, buddy? Hopefully today was really helpful about getting to a number. How do you get to a number? And if you don't know what the market rates are in your cap rate, if the cap rate is in your market, like it's a simple, a Google search can give you sort of an idea, and then you can sort of dive into the comps later on, but don't get inundated with that cap rate number. You guys will figure it out. The goal is to submit an LOI by Friday. I got identified a market on Monday. On Tuesday, I was cold calling like a fiend. We had a great answer rate yesterday. Man, that was fun. If you missed yesterday, go back and watch yesterday. That was a whole lot of fun. Cold called the broker from LoopNet yesterday. He sent me a 72 unit. We looked at the financials today. We underwrote the deal. Sort of wonky on the financials, but I guarantee I can get to a number, and you guys can too. So you get to a figure. Tomorrow, we're going to figure out how we're going to take the deal down. How are we going to take the deal down? Okay. I think that's going to be a limiting belief that, some of you guys may have is like, all right, well, how do I wrap my head around actually closing on this thing? Or if they accepted my LOI, how am I going to do that? We're going to talk about all that tomorrow. And then Friday, we're going to fill out the LOI and actually press send.